Hey everyone, hopefully you're having a good day. My name's Andy. The channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. So I always say that. I'm going to interject my financial opinion as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. If you're interested in joining the website, just to say that we do have a question and answer session going on right now between 7 a.m. and 10 a.m. on Mountain Standard Time. We do have a coupon code Mayday, and I will be going over the commodity kind of real estate cycle commodities and do a little training session at the beginning there. So let's go in, let's take a look and see what people are sharing. If you want to follow me at Binary_Finance, and if you want to join and get on that Zoom call, it's finding-value.com. So investment wisdom, I'll go through a couple of quotes here. There will be bear markets about twice every 10 years and recessions twice every 10, 12 years, but nobody has been able to predict them reliably. So the best thing to do is buy when shares are thoroughly depressed, and that means when other people are selling. He's completely right, and the biggest opportunities occur when everyone gets very fearful in the market and the share prices sell down to very low valuations. A margin of safety is necessary because valuation is an imprecise art. The future is unpredictable, and investors are humans and do make mistakes, says Seth. And another quote is Charlie Munger was right about it not being easy. I'm convinced that everything that's important in investing is counterintuitive, and everything that's obvious is wrong, says Howard Marks. And that's why it's not easy, because it's counterintuitive. So Minsky Moment, he says parabolic Nvidia chart can be described in just one word. Unsustainable is what he is talking about. What do we have here? We've got a gigantic move. Zero rates in COVID helicopter money. We've got the ALI exaggerated hype, potential head and shoulders chart pattern, unsustainable parabolic chart move, and $1,000 area psychological resistance is what he has posting here. What I'm going to tell you is this. I don't make predictions necessarily like this, and I know some people are really trying to time or call the tops here. But what I do is I just look for asymmetric opportunities and I look for undervalued investments because that's where your margin of safety is. Nvidia, it's overvalued. It doesn't have the margin of safety. It is nowhere near a bottom. So that's what I do. It's that simple. I'm not going to try to time this. And some people will be like, well, it's going up. It's like, that's great, guys. That's great. You go try to get your 20, 30, 40% gain. I want zeros on the end of it. I want 2,000% gain or a 10 bagger or something, which is a 900% gain. I want something that I am buying way down at the bottom. Nvidia would have been a good play in 2011, 2012, much along with all of the other tech stocks and or a lot of other stocks, 2009, 10, 11. All great entry points for stocks. In my opinion, we are coming up to a commodity bull market, and the great entry points are now. They are going to be 2020 through 2024. Of course, it kicked me out, went the other way. Okay, so here we go. U.S. Oil rigs are flat at 497. I do think that we're probably trying to bottom out here on the rig count. And then we'll see if we can increase rig count going forward. But I think we have to eat through a little bit of inventory first before the rig count does go up. But we're flat. We've got investment wisdom, another quote. If you're an even slightly above average investor who spends less than they earn, over a lifetime, you cannot help but get rich if you are patient. What I'm going to emphasize here, patient. A lot of people are pretty impatient. And what doesn't allow them to make all the money is their impatience. Patience is where you make the money. You find the window of opportunity to buy, you buy, and it takes patience for that investment to materialize and move higher. A lot of the times it doesn't occur in days or weeks, it occurs in years. And if you're really trying to buy a bottom, it might take some time to get out of that bottom where you make a ungodly amount of money. I think what the perception that a lot of people think is that you just buy it and it goes straight up. That's not how investing works, at least for these longer term holds where you're trying to get 10, 20 times your money. A lot of the times you're going to get a pretty big, nasty pullback, a few of them, over that big bull market run. So it's incredibly important to buy investments that are down, undervalued, and have the patience for them to turn into something that is more than just a 30 or 40% gain. So here's Calvin Friage. He says, or Froge, he says, nobody in finance talks about this chart. During the great financial crisis, the Fed began paying interest on reserves. This meant that banks could get paid without taking risk. This was when regulatory capture of the banking system truly accelerated. Pure moral hazard and evil. And this is the reserves of depository institutions total. And you can see this thing really rip into the upside here. You can see it kind of like rolled over before 2020, almost like they needed to manufacture some sort of crisis to really pump the system again. So it's pump, 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 pump away. Mike says a Texas maximalist friend in Austin was incredulous about how the California housing market could be so strong when Texas was not. Everyone hates California, right? I looked up this inventory chart and Zoe. Looks like Austin, Round Rock, San Marcos, Texas, they have a lot of inventory. Wow. Look at the move from 2021 upward. Sunnyvale up in the Bay Area in California, it's been actually really low in terms of inventory levels. So the inventory is being built over in Texas. The Kobayashi letter, he says, global asset managers still do not foresee a recession within the next 12 months. 78% of asset managers currently say that a recession within a year is unlikely. This is up from 65% recorded in March and the highest share of respondents since February of 2022. Meanwhile, in November of 2022, roughly 90% of portfolio managers anticipated a recession. However, as inflationary pressures are rising and higher for longer is returning, economic risks are growing. Is a soft landing still possible? So what I do is I just look and say, well, does this chart even accurately predict when a recession could occur? It does look like it dive bombs lower, maybe before a potential recession. And this definitely dive bombed lower very quickly in 2020, and then it dive bombed lower very quickly in 2022. In 2022, that was also when liquidity came back and gold bottomed in October of 2022. So liquidity came back into the market here, and maybe we pushed it higher from that liquidity. But that's what it says here for this information. EU natural gas inventories in percent of full. So they're at 67.72%. Germany's at 71%. Italy's at 72%. France is at 56%, and the Netherlands at 61%, Austria at 77%, and Spain at 86%, which is pretty full. It's pretty full. You can see what it's doing down here, and we're at the upper end of our storage capacity range. So we are a little bit on the full side for natural gas inventory levels. Today, gold posted another long red bearish candle, continuing its downtrend that began after forming a double top pattern and its all-time highs. This double top pattern is a strong bearish signal indicating that the market has twice tried and failed to break through resistance, leading to an increased selling pressure move. So if we look at the chart here, I'll kind of just describe, we had some pretty strong selling pressure back here. Then we just started ripping higher right on support, horizontal and across, diagonally. Moving on up, we hit some resistance again and we sold off. And I think that it's likely that this bottom path is probably going to be what transpires. We'll probably go down to 22.75 or something like that, is my guess. But I don't play the short term, guys. I just invest long term, but that's just a guess of mine. U.S. nat gas trades steady after falling on Thursday despite the storage report showing a smaller than expected build at 78 billion cubic feet, below the 92 BCF 5-year average. Stocks totaled 2711 billion cubic feet, some 29% above the 5-year average. So this is kind of what natural gas looks like in America. Let me just move this down a little bit there. So total natural gas and underground storage, you can see that we are on the upper end, definitely. We have too much inventory of natural gas, and that's obviously going to be bearish on the longer term, medium term. This is U.S. natural gas demand by week. Obviously, we're coming back down into what we call shoulder season. We've got weekly stocks versus the rolling 5-year average. We are above our inventory levels, are definitely on the upper end. And then dry gas production has definitely fallen on the bottom there. Let's see, there we go. And obviously we've fallen down in production to kind of slow down this inventory build is what they're trying to do. China's planning its biggest purchase of cobalt in history. So China plans biggest ever cobalt purchases for state reserves. Stockpiling agency could buy around 15,000 tons, according to sources, and critical material is cheapest it has been in nearly 5 years. So it's a good time to load up and stock your cobalt, I guess. Don Durrett says about a 13% premium in Shanghai for silver. We're 34.31 versus 30.5 in New York, keeping that pressure on silver to move on up. The Great Marti says the S&P 500 update. He has a diamond top. She's beautiful. So technical poetry, he's got a diamond top as a potential for the S&P 500 here. Could that transpire? We very well could. And maybe it is putting in a topping pattern. We'll have to watch it. And that is a big bearish engulfing right at the top there. Kevin says the data center story is a resource consumption story. Here are 4 data points that highlight the resource intensity of data centers. We need to 4x the available copper and aluminum to meet the demands of both the energy transition and data centers. So this is what we've got. It says today's power grid uses 5 to 6 MTPA of aluminum and 3 MTPA of copper. These numbers need to rise by 4x for the energy transition's grid's infrastructure. So we've got a long way to go in terms of aluminum and copper and how much we need to basically build out our grid infrastructure. Going on to number 2, the U.S. power sector capex needs to grow from $150 billion in 2024 to almost $450 billion in 2034. We have a lot of investment that needs to go into capex. A 30 megawatt data center costs around $300 million to build and needs to make $100 million per year to break even in 3 years. At 7.5 cents per kilowatt hour, energy is 17% of revenues. Okay. And then number 4, moving data costs 30% less than moving gas and 90% less than moving power. Proximity to power is the leading indicator of where future data centers will be built. So they're probably going to build these things next to power plants. And that's mostly move data here. It says moving data costs 30% less than gas. Both cost 90% less than moving power. Gotcha. So that's some information there. Alibaba revenue versus stock price over the last 10 years. Their revenue has gone up 2,047%. The stock price, minus 16%. Is Baba a sleeping giant? I would actually say that this is an excellent entry point here. It really is. Right here, right now, this looks like a very excellent entry point. We have a downtrend line that's broken. We have a double bottom playing out. I can draw a trend through here too, coming across. So I think it looks really good. Jan says Bloomberg. So let's read Curry here. Curry also sees a key difference between the current commodities rally and those of the past. This one has to do with the changing nature of so-called petrodollars. With major commodity producers no longer automatically recycling their dollar-denominated oil revenues back into U.S. treasuries, it is telling this recycling in the past would push interest rates lower, thus weakening the dollar and therefore putting more upward pressure on commodity prices. I totally agree with that. And that is what I'm watching in my daily updates to see if those interest rates, they push the interest rates lower, weakening the dollar. Totally agree with that. Now we see a different loop. So that's what it was back then. It says, for the first time ever, that dollar recycling is not occurring. And what is replacing it? I like to call it gold recycling, says Curry. It explains a lot of why gold prices are as strong as they are. And what is the evidence of that is that the emerging markets, the BRIC countries, all met with Saudi Arabia and other key participants in November of last year and discussed how they're going to trade with one another using local currencies. And then whatever it nets out in settling, they would settle in gold. So a little bit different than the previous bull markets with the dollar and gold, is his opinion, sir. We got silver price going up in this long-term channel that I posted, $300 an ounce possible, eh? So we've got a channel going across here and a potential move to the upper channel, maybe $300 an ounce. I just threw that up there as a possibility, not stating that's a price objective. We've got palladium on the long term also doing another channel kind of move here. And we're getting closer to the bottom of the channel and also to horizontal support for palladium. I wanted to read this. This is Kevin Bamborough. He says, Buffett's real key to success is understanding the game. Inflation helped him more than compound interest. Curiosity of central bank bailouts, maniacal money creation, and fractional reserve banking. Take one of his big investments, which is Coca-Cola. Well, they used to be 5 cents a bottle. When I was a kid in the 70s, the price spiked to 20, 25 cents. But you got a dime back for returning the bottle. Now, $1, $1.50. And they get that for selling crappy water too. Imagine the difference in profits for Coke. Margins would have held in percentage, but without inflation, they'd be 20% or less in dollars. Let me come on down here. He says, not taking away anything from his accomplishments, but I think it's important to understand that anyone can study major investment techniques and then apply them with great success. One key, though, will be navigating the decimation of the US dollar that will be coming. It says as well, you want to avoid the lost decades like the tech market from 2000 to 2010 or commodities from 2010 to 2020. Yes, with inflation, the major indexes do okay. And if you're a financial guy and feeling the hell out of your clients and compounding, you'll do well no matter what. But there's traps that should be avoided. Getting out of overvalued sectors nearing peaks and into undervalued sectors makes a massive difference in terms of risk and reward. That's exactly what I'm doing. I'm playing the big moves like tech. That's kind of overvalued right now. And the risk reward is favorable for undervalued sectors like commodities right now. And that's what's driving my decisions is where is the undervalued sectors at in the market? And how can I tell they're undervalued? That's what the ratios are. RevCap says Fed hasn't even cut yet. Home prices continue to reaccelerate, evidenced by a 5.6% year-over-year gain in the median existing single-family home price as of last month. Can you imagine what's going to occur if they lower interest rates? The affordability and all of those home buyers are going to go out and they are going to buy some homes, driving home prices up probably a lot higher than where they are today. U.S. air travel, TSA total traveler throughput in million passengers, 7-day average. So the 7-day average, 5.9% above the 2019 level. Look at that, guys. We are ripping it in terms of U.S. air travel. Wow. Hedge funds exposure to cyclical versus defensive sectors is at an all-time low. Look at that. So energy, the cyclicals include consumer discretionary, energy, tech, industrials, and materials. And then the defensive includes healthcare, utilities, and consumer staples. So we've got the hedge fund cyclical versus the defensive positioning. And we've got the least amount of money in the defensive positioning. Gold Ventures, he says, bears cheerleading because we had a 2-day dip. The gold-silver ratio did the smallest 0.236 retrace, silver a small 0.382. Is this all the correction we're going to see? Very possible. Don't get shaken out. I agree with the don't get shaken out. And this is the downward move where silver's starting to outperform gold. We very well could have a full retest move. That is still possible. Don't get shaken out of this, guys. It's a big trend change. And this is silver just priced in dollars and the pullback that we've got to 0.382. A lot of the times we get pullbacks to 0.618. That is a very popular pullback move, and that's at 28.51. Just an FYI. Peter Sutherland says OPEC will roll the cuts. Large inventory draws are coming. SPR refills will over-tighten the crude market again, just like last summer. Stay the course. There's nothing wrong with the oil market, and as adjustment factor reverts, participants will be caught off sides. Time spreads are the tell. We've got Scott here. He's talking about uranium and ChatGPT. Let's see what's up. He says the pattern in the Global X Uranium ETF URA chart appears to resemble a long-term bottoming process followed by a potential breakout. This pattern is often compared to various chart formations such as symmetrical triangles, double bottoms, and periods of consolidation before a significant price move. Hey, that kind of sounds like me. Another one, potential price targets and timelines. The short term, 1 to 6 months. If the URA breaks out from its current consolidation phase, it could reach its next resistance level around $40 to $50, given historical price movements and current market trends. Interesting. Eric Nuttall says, we remain bullish. We click on the chart. Global observable oil inventory onshore and oil on water, they are projecting and forecasting a gigantic decline in inventory levels. A big deficit is what he is projecting. The projection, minus 300 to 400 million barrels. That's a big boy there. Global oil days of supply in terms of oil price, and we are continuing to draw down our inventory levels on a global oil days of supply, and we are at 40 days. 40 days. Uranium, Scott, another one. It says price and valuation are different. Many seem to think uranium stocks are overvalued because they've already done a 5 to 10x from the bottom. How about if they just went from severely, severely undervalued to very undervalued? Please do net present value calculations at different uranium prices to see just how ridiculous some of these developers could get on $150 to $300 per pound pricing. Very ridiculous. We've got copper prices to rocket to $40,000 a ton, says top trader Andron. We've got Grady down here. This ratio chart shows how historically undervalued gold is relative to the U.S. currency supply. So gold has a very long way to go compared to the M2, and silver will outperform gold. And silver miners will outperform silver, plus everything else, really. Lifetime opportunity is now. And gold is starting to work its way on up against the M2 money supply. And here's silver. Silver is now sitting right at the $30 level. It has a massive breakout regardless of which yellow trend line you use. Question is, will it hold the 30 level for the month? And that's what we're trying to hold, 30. Let's break this bad boy to the upside. Bullish trend. If you are curious to know if Canadian oil companies make money, Canadian oil sands making money at 74 a barrel. Looks like Permian's even higher than that. Canada offshore, $60 a barrel. So they are making some money, just not a ton of money, which is good because higher cost producers are the ones that move the most in a big bull market of oil. Coming down, Grady's saying this is a very bullish chart for precious metals. Gold miners have turned a huge corner versus the general stock market. And the general stock market is at an inflection point right here, which makes the ratio chart extra interesting. So it begins, be ready for it. GDX versus the S&P 500, it's made a turn, and hopefully we can continue to make a move higher where GDX outperforms the S&P 500. Very probable false breakout there on the bottom side. That's your slingshot. And that's where we're going to end it, guys. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got our question and answer session going on right now. Jump on the Zoom call if you're a member and you want to participate. Either way, I do record them all and upload them to the website, even if you miss it. All right, guys, that's all I've got for today. We'll catch you next time. This is Finding Value.